I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi there. I have read a fair amount of investing and motivational books in my life, and I gotta say, one of the best ones is definitely The Psychology of Money by Morgan Housel. Morgan takes something that most people seem to overcomplicate, and he simplifies it, and doing so by telling a story which makes everything a little bit extra entertaining.
Are you not entertained? Are you not entertained?
The book is fairly easy to read. It's only 20 chapters, 238 pages, and they're filled with good stories and anecdotes about the consequences of the choices we make or don't make. In this video, I'll do a quick recap of the book and the nuggets in it, but I have garnered it with Morgan's interviews on the best chapters. So, let's enjoy the show.
Hi, I'm Morgan Housel. I'm the author of the book, The Psychology of Money. I've been a financial writer and investor for my whole career. I want to share a few things that I've learned along the way and how you can manage your own money in a better and more effective way. And now let me start with the good news for you, which is that you don't need to be a genius to do well financially. Let me repeat that because I think it's so important. You don't need to be a genius to do well financially, to save a lot of money, to retire on your own terms, to avoid some of the biggest mistakes that people make in their financial lives. Doing well with money doesn't require going to the best college or being really good at math or knowing the right people, having the right connections. We often think it does because that's what the financial industry has led us to believe. But doing well with money is not about what you know. It's not about how smart you are. It's just about how you think and how you behave.
Intro, the greatest show on earth. Well, Morgan leads out with his years of working as a valet at a nice hotel in LA. He saw a lot of wealthy people and noticed their behavior. This left a lasting impression on him and shaped his way of thinking. It started him on his journey to understand why some people become rich and some people don't. And, maybe even more important, how to keep their money and don't go broke. He realized he had to look at human psychology instead of finance and interest rates, etc. It's all a matter of mindset. But let's hear that from Morgan himself.
When I was in college, I was a valet at a high-end hotel in Los Angeles. So I was in my early 20s, and there were people coming in Ferraris and Lamborghinis and Rolls Royces, like the whole thing. And it dawned on me one day that when those cars pulled in, that I had really admired. I'm a car guy. I love that. Never once did I look at the driver and say, that guy's cool. What I did is I imagined myself as a driver, and I thought people would think I'm cool. And this was like I was in my early 20s, but I'm just thinking like, that was my first kind of light bulb into how wealth works, that everyone thinks that they want to be the driver, but no one actually is paying attention to the driver. They're imagining themselves. People think about themselves way more than they think about other people. But we all think that everyone's looking at us. I think that's like a universal thing. Everyone thinks like, oh, this person's looking at me. They're impressed with me. By and large, they're not. They're thinking about themselves and how other people might want to be impressed with them.
Chapter 1. No one is crazy. What may seem crazy to you is not necessarily crazy for others. They can have a completely different frame of reference than you. They had a different upbringing, they had a different life, different experiences, and, as Morgan mentioned several times, they're not even necessarily playing the same game as you. A person who grew up in a poor family will act vastly different than one who grew up rich.
And I think this is important. The point I wanted to make about this in the book is that people make all kinds of crazy decisions with money. They do crazy things. They do stupid things with money. But no one is actually crazy in the moment. Every financial decision that everyone makes, the decisions that I make and the decisions of the people buying lottery tickets, it checks the boxes in your head that you need to check to say, this is the right thing for me to do right now. And to me, that's just highlighting how emotional and psychological money is. It's not something that you can solve on a spreadsheet with math and formulas. It's much more just emotional and has to do with the individual context of your situation, the psychology of your in the moment circumstances that leads us to these decisions. There's things that I do with my money too, that people would say, Morgan, rationally, that's a dumb thing to do. You shouldn't be doing that. And my answer would be, look, I know it's not rational, but it feels good to me. This is what I'm doing. It checks the boxes in my head of what I want to do. And that's why I do it. And I think it's okay for people to realize that equally smart people can and do disagree about the decisions that we make with our money, because money is not like math, where 2 + 2 = 4 for me and you and everyone else. Everyone has a different background, a different life, different goals. They view the world through a different lens. And therefore, we make different decisions about what to do with the money. And that's okay.
Chapter 2: Luck and Risk. Nothing is as good or as bad as it seems. Luck and risk are siblings. They're both the reality that every outcome in life is guided by forces other than the individual effort. You know, you are the one person in a game with 7 billion other players and infinite moving parts. When things are going extremely well, realize it's not as good as you think. You are not invincible, and if you acknowledge that luck was a factor in your success, then you have to believe in luck's cousin, risk. Risk can turn your story around just as quickly. And as luck is a lousy teacher, it seduces you into thinking you can't lose. Failure is also a lousy teacher. It makes you think your decisions were terrible. Realize they're both a part of the journey and learn to accept them.
And there are a lot of people that will define risk differently, by and large, based off of the time horizon. So if you were to ask me if the stock market fell 20% and stayed there for 3 years, is that a risk? A lot of people would say, yeah, that's a huge risk. That's an enormous, catastrophic risk. I personally would say that's not a risk at all. And the reason is because my goals lie 50 years in the future. So what's going to happen in the next 3 years? I could honestly care less. That's really how I think. But that would not be my answer if I was a 90-year-old retired widow on a fixed income. Then I'd have a very different answer for you. So I think, summing all that up, risk is just the odds that something will prevent you from achieving your goals. But the nuance is that everyone has very different goals and aspirations and time horizons. So everyone thinks about risk differently. The takeaway from that is most investing debates where people are arguing with each other, is this a risk? Is that a risk? Should I buy this stock? Is the market going to go up next week? By and large, those debates are not actually debates. It's people with different risk tolerances and different time horizons talking over each other, talking over one another. And that's why. So I think, to me, the most important part about risk is that the definition is different for everyone. My definition is going to be different from yours, which is different from anyone else who's listening. And it's not because we disagree with each other. It's just because we're different people with different goals and different ages and different family situations, et cetera, et cetera. And so risk is a very personalized calculation for everyone, whether that's in investing or other areas of your life.
Chapter 3: Never Enough. Morgan talks about getting the goalpost to stop moving, knowing your ultimate goal, and stopping when you reach that goal. If you keep swinging for the fences forever, eventually you will introduce enough risk and could end up broke.
The hardest, but probably most important financial skill, personal financial skill, is getting the goalpost to stop moving. It's great to have goals. I have goals. Everyone should have goals. But once you meet those goals, the natural progression is to say, okay, I checked that box. What's the next level up? What's the next rung that I should shoot for? And that game for some people never, ever ends. Unless you are Jeff Bezos and Elon Musk, there is someone else getting richer than you are right now. And if you are always just going to keep looking up and up and up, that's a game that I think a lot of people don't necessarily want to play. Some people might like that game, but some people want to say, no, what I want out of my financial goals is a level of peace and independence in the future. I can sit back and enjoy the hard work that I've earned and built up over time. And if the goalpost never moves, I think you're never going to really sit back and enjoy what you've earned. So it's so incredibly important. It's so difficult as well. I try to think about it with my own financial goals of how much is enough. What is the net worth at which I would say, okay, I'm really going to scale back work now and spend more time with my friends and family. I have that number in my head. And if I'm lucky enough to get there, will I actually do it? I hope so, but I don't know. It's a very difficult thing to do. But I have seen, I'm sure you have seen, and everyone watching has seen, people who are very successful beyond their wildest dreams. And when they get there, all they can think about is the next level. I'll tell you just a personal story of this. There is an author who I really look up to. I will spare his name, but I really look up to as, man, I wish I could be as successful as that author. And I had a conversation with him last week. And during that conversation, all he talked about was this other author that he looks up to. And it was so jarring for me that in my mind, I want to be this guy, and all he wants to be is some other guy. Like, we're all just playing this silly game. And I think all three of us should say, all three of us authors should step back and realize that we're fortunate to be in this position and be grateful for what we have. You can be grateful for what you have and still be ambitious. It's not to cut everything off wholesale, but I think realizing that everyone needs to have an idea of what is enough is so important, because if you don't, by and large, a lot of people will keep taking risk, will keep stretching, keep swinging for the fences until they break. Someone like Boone could break and then build back, but a lot of people, once they break, they're done.
Chapter 4. Confounding Compounding. In this chapter, Morgan tells the Warren Buffett story and shows us why compounding and time is so important. As Einstein said, compounding is the eighth wonder of the world.
A point I make in the book is that Warren Buffett, who's now worth $100 billion, 99% of his net worth came after his 50th birthday. And 97%, I think it's 98% now, has come after his 65th birthday, which is really important, because if Warren Buffett had retired at age 60 like a normal person, you never would have heard of him. He never would have become a household name. No one would have, he would have retired to Florida with a couple $100 million like a lot of people have, to play golf. And the reason he is so successful is because he's been investing for 90 years and he's let compounding run wild. That's the key to his success. Is he a good investor? Yes, of course. But his real secret is that he's been a good investor for 8 or 9 decades where compounding can go nuts. That's all it is. But that explanation, that the reason that Warren Buffett is so rich is because he's been compounding for so long, it's just the time he's been investing for, is not intuitive. So you have professional investors, really smart investors and business people, who will dig into grand detail about how Buffett thinks about business models and market cycles and moats. And a lot of that's great. You can learn a lot from that. But the reason he is so rich and so successful is just the amount of time he's been investing for. We know that's just a simple matter of math. We can just say the reason he's so successful is because he's been investing for 90 years, period, end of story. And so I think when it's not compounding, the math is not complicated, but it's not intuitive. It's easy to overlook like where these forces are coming from and what we should actually be looking up to in the business leaders or investors who we are trying to admire.
Chapter 5. Getting wealthy versus staying wealthy. Good investing is not about making good decisions, it's about consistently not screwing up. In this chapter, Morgan mentions some of the smartest people and best investors and famous people who all made billions and lost it all, just because they didn't have the mindset and felt a need to flaunt their wealth and overspend. Just like Mike Tyson said, everyone has a plan until they get punched in the face.
The difference between getting rich and staying rich are two separate skills, and you have to nurture them on their own. And those skills can often contradict each other, which is why it confuses people. The way I've often framed it as people should save like a pessimist and invest like an optimist. What I mean by that is this. You want to invest like an optimist. Getting rich requires being an optimist, swinging for the fences, taking a risk, being optimistic about people's ability to solve problems, for companies to become more productive, for those profits to accrue to shareholders. That requires optimism to get rich. Staying rich requires almost the polar opposite. You need a level of pessimism and paranoia and an acknowledgement that a lot of what economic history is a constant chain of setbacks and disappointments, recessions, bear markets, pandemics. You need to be able to survive financially and endure so that you can stick around long enough as an investor to enjoy the long run and to compound your assets that are invested in the long run. A lot of people view optimism and pessimism as black and white. You're either one or the other. I think they need to coexist with themselves, and you need to have this cognitive dissonance of part of your brain is always an optimist and part is always a pessimist, and they work with each other to keep you in the game for long enough for your assets to compound.
Chapter 6. Tails, you win. You can be wrong half the time and still make a fortune. Morgan talks about the end of the distribution curve, the tail, like the S&P 500. The majority of the companies in the index are not the best performers. Some even go bankrupt, and a lot of them underperform. But a few of them outweigh and overperform, and these are the real winners. Those are the tail of the distribution curve. In the Berkshire 2013 shareholders meeting, Warren Buffett mentions he has owned over 500 different stocks during his life, and he made most of his money on only 10 of them. Charlie Munger added, if you remove just a few of those, Berkshire's long-term track record would be average. And as George Soros once said, it's not whether you're right or wrong, it's how much money you make when you're right and how much you lose when you're wrong. You can be wrong half the time and still make a fortune. Peter Lynch has the same in his book, One Up on Wall Street, where he says, if you have 10 investments equally weighted, just one of them can make you all your money, even if half of the others go broke.
It's true that for any investor, whether you're talking about an individual investor saving for retirement or a professional like Warren Buffett, that the majority of your lifetime success will come from a tiny portion of the investments that you make. If you were to make 100 investments, you will probably earn most of your returns on 5 of them, and you'll probably lose money on half of them. That's normal. That's just how capitalism works. And it's very easy, again, like if we were trying to idolize Warren Buffett and look at his career, to look at his great investments, Geico and Coca-Cola and American Express, without realizing how many investments he has made that have not done that well. Not to get too technical about this, but if you look at Warren Buffett's whole career, he has made about 500 investments over the course of his career. If you remove 5 of them, 5 of the 500, his career track record is average. So that's like all of it. And Warren Buffett's teacher, a guy named Benjamin Graham, is one of the most famous investors of all time. If you remove one of his investments from his career track record, it's below average. So this is always how it works. This is true for companies as well. You take a company like Apple that has experimented with hundreds or dozens of products over time, but the one product that really moved the needle was the iPhone. And they've made dozens of products, but it's one that was just a knockoff. That was just an out of the park success. Amazon is the same. Amazon has tried to do dozens and dozens of different businesses, but what really worked was AWS and Prime. That's what made Amazon what it is. So it's always the case that just a couple of things move the needle in a way that gives us a really warped sense of risk. Because if we are investors and we make 100 investments and half of them lose money, it's easy to kick yourself and say, I don't know what I'm doing. This is wrong. This can't be right. Even if that is a normal path, that's the normal dynamic of growth over time. So just wrapping your head around the fact that tails, kind of the tail distribution of outcomes, is all that matters in the world. That's really what moves the needle. Makes you more comfortable losing money once in a while, or some of your business ideas that don't work out. It's okay. That's a normal path of growth. And it makes you much more cognizant that, 1 or 2 good ideas is really all you need to do very well over time, whether that's in investing or your career or anything like that.
Chapter 7, Freedom. Controlling your time is the highest dividend. What does money do for you? Why do you want to be rich? What's your rich life? Use money to gain control of your time. Time is the ultimate currency.
I think if there is a universal trait of money that's true for like not 100% of people, but let's say 90% of people, is that what people really want in life is independence and autonomy. I think no matter where you're from, what you do, what your aspirations are, that's a common denominator. That people just want to wake up every morning and do what they want to do on their own terms. And whether they're able to do that, whether that they can actually do that today, or that's a goal. I think that's a universal trait among people, is just independence and autonomy. And so to the extent that we can use money to gain independence and autonomy, that is, I think, as close as it comes to a universal want and thing that we can use money for. The interesting thing to me is that among huge numbers of people, educated people, financial professionals, the purpose of money is to buy stuff. It's to accumulate more stuff, bigger house, nicer car, whatever it might be, which is great. I love all that stuff too. But to me, the most powerful thing that money can do, and the most universal benefit that it can bring us, is systematically overlooked. Like using it for independence and autonomy is so overlooked. And that to me has always been kind of a sad thing, that we are so accustomed and attuned to just wanting to use our money, whatever money that we have, whatever savings that we have, to go out and buy more stuff when we could be using it for freedom and autonomy. And then when you come to a period like in March and April of 2020 or October 2008, when millions of people lose their jobs, and you see during those periods, like the early day of COVID, how many people are just on the razor's edge of insolvency. And it does not take them much, 1 or 2 weeks of unemployment to be in a really bad financial spot, whether that's for an individual or a small business. It does not take them much to be thrown over the edge. And you realize how dependent so many people are on their jobs, their salaries, their customers in a short period of time. And there's just not a lot of room for error throughout most of the world. And I think for the huge majority of people, not everyone, but for the majority of people, there could be a lot more. And the reason that they don't want to have more savings is because to them, the knee-jerk reaction is, why would I just keep my money in the bank or even invest it? Like, the purpose of money is to go out and buy more stuff to enjoy my life. I get that. I understand it. But it's usually once every 5 or 10 years that people realize how important independence and autonomy is. And having that wealth that you have not spent, having the money that you haven't spent, that was just laying around doing nothing, becomes the most valuable thing in the world when it lets you gain control of your time and just wake up every morning and say, I can do whatever the hell I want today. I think that's as close as it gets, Tim, to like a universal financial law.
Chapter 8, Man in the Car Paradox. Well, this one is in several chapters in the book, but here he goes into deep and tells you, no one is impressed with your possessions as much as you are.
One day it hit me. I remember the moment because it was like out of the blue, it hit me. Whenever someone would drive in a Rolls Royce or something, never once would I look at the driver and say, that guy's cool. Like, wow, look at him. He's so cool. What I did is I imagined myself as the driver. And then I thought, if I was a driver, people would think I'm cool. And it was like, wait, don't you see like the disconnect here? Nobody cares about the driver, but they want to be the driver because they think people will then care about them. And once you realize that, like, the takeaway is nobody is thinking about you as much as you are. Nobody cares about your stuff as much as you do. Nobody cares about your car or your house or your clothes or your jewelry as much as you do. Because to the extent that they're even looking at them, they're looking at your car, looking at your house, really what they're doing is imagining themselves with that nice car. They're not giving you the credit. They're imagining themselves having it. So once I realized that was the game that was being played in society, once you recognize that's the game, your willingness, your desire to show off plunges. And of course, I like nice stuff. I like nice cars. I want some nice clothes. I live in a decent house. But once you realize that, it plunges. And I think the most valuable financial skill that anybody can have is not needing to impress other people. If you don't need to impress other people, that is an asset on your balance sheet that is worth $1 billion. Because so much of society as a whole and an individual is just geared towards, how can I get other people's attention? How can I show off to other people? How can they like me more?
Chapter 9. Wealth is what you don't see. Spending money to show people how much money you have is the fastest way to have less money.
And so I think a lot of people that are very good savers and save a lot of money and accumulate a lot of wealth are not necessarily the people who you would think. It's not necessarily the person who went to Harvard and works on Wall Street and drives a Ferrari. You know, there are a lot of people like that are legitimately wealthy, but a lot of people who are wealthy as well are who you would never imagine. Because I think what's important about wealth, and this fools a lot of people, is that wealth is what you don't see. Maybe this is obvious when I state it, but it misses a lot of people, that wealth is the money that has not been spent. So wealth is the cars that you did not purchase. It's the house that you did not buy. It's the clothes that you did not buy. It's money that you have saved and invested for the future. And since we don't see wealth, it's very easy to mistake who is actually wealthy in the world. So I make this point that if you see someone driving a Ferrari, it's easy to say, oh, that person's wealthy. And maybe they are. But the only thing that you actually know about that person is that they have $300,000 less than they did before they bought the Ferrari. That's all you know about them. And so when you realize that wealth is what you don't see, it makes it, you're more careful about finding role models. I make this point that physical fitness is visible. If someone is in good shape, you can see it. If someone is in poor shape, you can see that. So it's easy for us to have physical role models. I want to look like this person. I don't want to look like this. This is my inspiration to exercise because you can see it. But since wealth is not visible, it's much harder to have role models, because it's easy to say, oh, John has a lot of money. I want to be like him. Joe, the janitor, does not have a lot of money. I don't want to be like him. But you have no idea. You don't see their bank accounts. You don't see their brokerage accounts. You really have no idea.
Chapter 10. Save money. The only factor you can control generates one of the only things that really matters. Isn't that wonderful?
So I think, look, and it's very different if we're talking about the lower strata of income, that really, no matter how hard you're trying, the ability to save a meaningful amount of money is going to be very difficult. I can empathize with that and have a lot of respect for that. But for a lot of people watching this right now, a lot of their ability to save relies on lowering their ego. It's just a matter of saying, look, this is my income, regardless of what it is. And a lot of what I'm spending on is to social signal to the world. say, look, I have a bigger house than I might need, a nicer car than I might need. And your ability to save is going to be heavily reliant on not necessarily earning more income, but managing your lifestyle, managing your expenses. Wealth is a two-part equation. You have your income and your expenses. And in the industry, in the finance industry, we spend almost all of our attention on the income side. How do we earn more money? How do we earn more money in our investments? And the expense side, I think, is just as important. It might be more important because you can control it more than your ability to, you have no influence over what the stock market's going to do this year, but you have a lot of control by and large relatively to what your expenses are going to be. So I think once you realize that, then your ability to save money just might become a little bit more in your control and more realistic than you think it is. If you realize that, wealth is the gap between your ego and your income, is how I put it in the book.
Yeah.
Chapter 11, Reasonable versus Rational. Aiming to be the more reasonable works better than trying to be very rational. For instance, there are few variables more correlated to performance than commitment to a strategy during the lean years. Meaning, if you invest in a promising company you don't care about, you might enjoy it while everything is good. When the tide inevitably turns, you suddenly lose money on something you're not interested in, and you're very likely to dump it and move on. And then you will typically miss out on the great gains down the road.
I think investing tends to be viewed like math, like 2 + 2 = 4 for me and you and everyone. There's one right answer in math, but investing is not that. Investing is such a personal endeavor where how I behave is different from how you behave. The lens in which I see the world is a different lens from that in which you see the world, and everyone sees the world. We're all different. We come from different generations, different upbringings, different incomes, different goals, and because of that, we view risk differently. The big takeaway for that for me is that equally smart, educated, informed people can and do disagree with each other, and that's fine. We should all just pick the investing strategy that works the best for us and aim to not be coldly rational on a spreadsheet, but aim to be reasonable. I think being reasonable is the best that you can do in investing. It's just this idea that very few people make an investing decision or a finance decision on a spreadsheet. They make it at the dinner table, where they're discussing it with their spouse and their family. That's where financial decisions are made. And that dinner table is much messier and more nuanced and more emotional and more hormonal than anything you can model on a spreadsheet. That's really what it comes down to. So understanding who you are and what you want, and realizing that your goal for managing money should not be to be perfectly rational. It's to give you a better life. That's what we all want out of this, just from a philosophical point of view. And if making investing decisions that aren't rational or don't seem right make you happier and keep you in the game, then that's the right thing to do. I mean, here's one example that I'll give you, Ted. There is a well-documented home bias in investing. It's documented all over the world where American investors, by and large, only own U.S. companies. German investors only own German companies. Japanese investors only own Japanese companies. It's like this all over the world. It's not rational at all to think that the best stocks that you should own are the ones that are closest to your house. That's not rational in the slightest, but it's actually a very reasonable thing to do, because if only investing in companies that you're familiar with helps you take the leap of faith to invest your long-term savings in these companies and is going to give you more confidence to stick with them for the long run because you're familiar with them, that is totally reasonable. It's not rational, but it's very reasonable.
Chapter 12, Surprise. History is the study of change, ironically used as a map for the future.
Yeah, it's just the idea that people, if you look at the economy, people are very good at predicting what the economy is going to do, except for the surprises. And the surprises tend to be all that matter. So that's why the history of economic forecasting is so bad. It's not because we're not smart enough. It's just that by definition, you cannot predict a surprise like COVID or 9/11 or whatever it might be. And so to me, the anecdote for that, like if we are in a world where the biggest risk is what nobody is talking about, how can you prepare for that? To me, the only way is that you should have a level of conservatism in your finances that feels like it's too much. Your level of liquidity and your debt levels should feel like they are too conservative, because that's when you at least know that you have a fighting chance of being prepared for something that you can't even fathom. If you are only saving for the risks that you can envision, by definition, you're going to miss a surprise every single time. And a lot of companies fall for this. A lot of people fall for this too. And they're like, oh, like I've done a risk management assessment and these are the risks that I'm facing, and I have enough liquidity or insurance or whatever it might be to handle those risks. You're like, okay, but look at the history of risk. It's always something that nobody saw coming.
Every single time. In any given calendar year, the biggest news story is something that was completely unpredictable at the beginning of that year. Every single year. It'll be like that going forward as well. So, I do this for my own finances. If you look at my level of cash relative to my net worth, anybody would look at it and say, why is it so high? Like, what are you preparing for? Are you saving this up for this event? And I say, no, I have no clue what I'm saving that for. I'm saving it for a world in which everybody is constantly surprised by what gets thrown their way, whether it's individually, whether it's a medical issue or a divorce or a job loss, whatever it might be, or macro, like 9/11 or COVID, these like massive events that upend everything.
Chapter 13, Room for Error.
The most important part of every plan is planning on your plan, not going according to plan. It's a mouthful, I know, but I think it's so important. So the most important part of a card counter strategy is making sure that they can survive a long string of losses that they know are inevitable. Not just possible, but guaranteed to happen. They constantly had to manage their bets to withstand lots of losses, even when they had a perfect strategy. Which, of course, is the same way it works when you're dealing with your own money. Saving money in life would be easy if everyone knew exactly what the future held. If you knew what your expenses would be in the future and what your future setbacks would be, what your future goals would be. But the truth is, we don't. Nobody can predict the future of the economy with any kind of precision. And no one even knows what they themselves or their families might face in the future. The world is full of surprises. And that's not a fun reality to accept, but that is the reality. And what it means when managing our own money is that the best we can do is try to find a financial plan that puts the odds of success in our favor. Not a perfect plan, not one that's guaranteed to work, because those don't exist. Just ones with the highest odds of working. And in practical terms, what that means is that we need to save for expenses that we can't even imagine today. Because we know that there are going to be setbacks in the future, unexpected setbacks and surprises. We need to invest our money with an eye towards endurance, the ability to survive a continuous chain of disappointments in the world and setbacks and surprises that we know will be a part of our future. And look, financial planning is essential. Everyone should do it. Having a financial plan about what you think your future expenses are going to be, how you're going to save it, that kind of a plan. We have to recognize the most important part of any plan is planning on that plan, not going according to plan.
Chapter 14, You Will Change. Long-term planning is hard because people's goals and desires change over time.
I think there's definitely a case. I use the example of Travis Kalanick, who is the founder of Uber. He had the exact right personality and management philosophy to bring Uber from 0 to 100. And he was the exact worst person that you could imagine to bring Uber from 100 to 1,000. And so there's a lot of times where your specific personality is going to work really well in this situation and be disastrous in another. And I think that could be true at different phases of your life. If you are someone who is the life of every party and you can drink people under the table and you're loud and you're boisterous, that is an amazing personality when you're 21. If you are still that person at 47, it's probably a disaster. That's not the personality you by and large want at 47. So sometimes what works in one area like doesn't scale to other areas of your own life. And if you don't realize that, you can't change course. It's a tough road for a lot of people.
Chapter 15, Nothing is free. Everything has a price, but not all prices appear on labels. Everything with money has a price. The trick is figuring out what the price is and if you're willing to pay that price.
It's just this idea that everything that's worthwhile in life has a cost of admission, has a fee that you have to pay. A lot of those fees are not price tags. They're not priced in dollars, so to speak, but there is a fee. The price to pay for good returns in the stock market is pretty obvious. This is not a groundbreaking idea that I have, but it's putting up with and enduring volatility. Now, what's important about this is that a lot of investors do not view volatility as a fee, as the cost of admission. They view it as something different. They view it as a fine. The difference between a fee and a fine is subtle, but it's very important. A fine means you did something wrong. Shame on you. You made a mistake. Here's your fine. Don't do that ever again. A fee is a cost of admission for getting something that you want on the other side. You go to Disneyland. It's $100 to get through the door. And congratulations, you're not in trouble. It's $100. Now go enjoy the theme park. That's what a fee is. And I think
viewing volatility as a fee instead of a fine is very important, because a lot of investors will view, if their stock portfolio went down 10 or 20%, let's say, will view it as an indication that they made a mistake. They screwed up. Their financial advisor made a mistake. This is wrong. I'm not supposed to lose a fifth of my money. This is a fine for doing something wrong. That's how a lot of investors view it. And I just think it's much better, a much more productive and accurate way to view volatility as a fee, the cost of admission for getting superior returns than you can get in cash or bonds. You can, of course, earn much higher returns in the stock market than in cash or bonds, but you have to put something forth to that. There is a cost of admission for that. And the cost of admission is volatility. You have to be able to put up with, historically, every 4 to 7 years, the stock market has lost between 20 and 30% of its value at least once. That's a historical average. I would expect that to be the case going forward. Now, the important thing is that at every one of those 20 or 30% declines, you have investors all over the world who say, this can't be right, something feels wrong, this feels broken, and so I want out, without realizing that it's actually just the cost of admission that you have to be willing to pay to do well.
Chapter 16. You and Me. Beware of taking financial advice from people playing a different game than you are, just like a random guy on YouTube.
Just general advice was go your own way and figure it out for yourself. That's really hard advice to achieve, because everybody wants a playbook. Everyone wants a map, but just hey, you got to figure this out for your own. And on the extension of that, the flip side is the worst advice is, here's what you should do. Let me tell you the path you need to go on. Let me tell you the route you're going to take. Let me tell you why you're doing this wrong.
The takeaway from that is most investing debates where people are arguing with each other, is this a risk? Is that a risk? Should I buy this stock? Is the market going to go up next week? By and large, those debates are not actually debates. It's people with different risk tolerances and different time horizons talking over each other, talking over one another. And that's why, so I think to me, the most important part about risk is that the definition is different for everyone. My definition is going to be different from yours, which is different from anyone else who's listening. And it's not because we disagree with each other. It's just because we're different people with different goals and different ages and different family situations, et cetera, et cetera. And so risk is a very personalized calculation for everyone, whether that's in investing or other areas of your life.
Chapter 17. Seduction of Pessimism. Optimism sounds like a sales pitch. Somebody is trying to sell you something. Pessimism sounds like someone is trying to help you.
So it's not to say that the threats don't exist. Of course they exist, and they're very real. They're very dangerous. There's never been a time when that's not the case. So that in itself is optimistic. They're like, yes, it's bad, but it's always bad. And people figure out solutions to it and you move on. The asterisk to that of people figure out solutions and move on is if you are a survivor financially or survivor literally, meaning you don't get wiped out in the stock market. You don't give up on stocks. You don't you can maintain and discipline and stay standing for the next 20 or 30 or 50 years. The long history of humans figuring problems out and finding solutions and ending up not just okay, but way better off than they were before is extraordinary. The biggest technological improvements, the biggest move forwards in the world happen and come specifically from the biggest tragedies. The most technologically progressive event that's ever happened in human history was World War II. The number of new technologies that benefit my and your life today that came because of World War II are off the charts. Satellites, internet, penicillin, jet engines, atomic energy, microwaves. The list of what we discovered because of the war is off the charts. That would not happen if it were not for the war. And so I think that's the case for optimism today, despite the problems that we have. A, we've always had problems. And B, it's the problems that we face today is exactly the fuel that we need to figure out solutions to those problems that's going to leave us much better off at some point in the future.
Chapter 18. When you'll believe anything.
What is most compelling to us, the information that is most convincing to us, is what we want to be true. Not what is true, but what we desperately want to be true, particularly when you're desperate to be true. You see this a lot in business and investing too, where what's most compelling is what you just desperately want to be true. And this is true for a lot of investors, particularly older investors who are nearing or in retirement, who will say look, I don't have okay, Mr. Investor, you're telling Mr. Financial Advisor, you're telling me that I need to have a 10-year time horizon in the stock market because that's when the odds are in my favor. But if I'm retired, I don't have 10 years. I might have 2. So I need to earn my returns over the next 2 years. And look, the market doesn't know or care what your time horizon. It's going to do whatever it's going to do. But people in these situations tend to believe people who are willing to tell them, oh, I can earn you great returns every 6 months, every 12 months. They believe it because they need it to be true. And so I think it's a natural instinct for everyone to believe, particularly not what you want to be true, but what you need to be true. If you need to earn these returns so that you can retire, if you need to have this medicine to save your son's life, if you need it to be true, desperately need it, your reasoning and ration kind of goes out the window.
Chapter 19, all together now. In this chapter, Morgan recaps the learnings from the previous chapters. I won't do a complete recap, but I have found the single most important thing from the book, and it's right here.
I think is that doing well in finance, doing well with money, is not necessarily about what you know. It's not about how smart you are or where you went to school or how sophisticated you are. It's overwhelmingly just about how you behave. It's about your ability to be patient, your ability to keep your ego and your spending in check, your ability to have a long-term mindset, to think about the future. And those things really have nothing to do with your education or where you went to school. Those are just much more personality-driven psychology traits. And so I think a lot of people that are very good savers and save a lot of money and accumulate a lot of wealth are not necessarily the people who you would think. It's not necessarily the person who went to Harvard and works on Wall Street and drives a Ferrari. There are a lot of people like that are legitimately wealthy, but a lot of people who are wealthy as well are who you would never imagine, because I think what's important about wealth, and this fools a lot of people, is that wealth is what you don't see. Maybe this is obvious when I state it, but it misses a lot of people, that wealth is the money that has not been spent. So wealth is the cars that you did not purchase. It's the house that you did not buy. It's the clothes that you did not buy. It's money that you have saved and invested for the future. And since we don't see wealth, it's very easy to mistake who is actually wealthy in the world. So, to me, I'm a saver, but we don't spend a lot of money. We don't buy a lot of stuff. We live a very comfortable, very nice, lucky life. But what we save money for, my wife and I, is to be able to control our time. That's what I want money to do for us. I want to save money and grow wealth over time, not so that I can buy a bigger car or a bigger house, but so that I can wake up every day and just say, I can do whatever I want today. I can do what I want, when I want, with whom I want, for as long as I want, because I've saved up a level of money that gives me independence and autonomy in my career, and autonomy in terms of where I want to live, how much time I want to take off, when I want to retire. That's what I want to use the wealth for. So it's
Chapter 20, Confessions. This is a bonus chapter where Morgan Housel explains his own investing strategy, and basically it's, I don't pick stocks, I don't pick sectors or time the next recession, I have a high savings rate, I have patience and optimism that the global economy will create value over the next decades.
Really important. And I explain this in that chapter about what my wife and I do. There are things that we do with our money that I can't explain on a spreadsheet. They're not rational. I know they are quote unquote bad financial decisions, but we do them because it fits our personality. It helps us sleep at night. And so I think people should be more open to that, to just being like, look, I do this thing with my money, whatever it is, that is probably not the greatest idea financially on a spreadsheet, but it makes me happy. It helps me sleep at night. It fits my personality. And I don't need to explain that to you because you're not me and I'm not you. I think more people should be open to that. So that's probably the biggest mistake that people make, is trying to fit their decisions into the framework of someone else's logic. And to me, if you are chasing the highest returns, you are much more likely to have to interrupt your compounding at some point when those returns mean revert, where the technology that you're chasing, you realize you don't really understand it, it gets disrupted by something else, et cetera, et cetera. To me, all I want to do for my personal money is make sure that the stocks that I do own, I can leave alone for 50 years. That's it. Because I know that if I can do that, I'll achieve every financial goal that I have and then some. So then my challenge, my tactics are, how can I situate my mindset and my financial life to make sure that I never have to touch those stocks? And for me, that's a really simple, basic kind of average return situation. The other thing is just realizing that compounding is just returns to the power of time. And in any exponential equation like that, the exponent is really what drives things, to crazy numbers over time. So to me, it's not necessarily who can earn the highest returns. It's who can earn good returns for the longest period of time. That's what really gets to it. And if you were to ask like, hey, you can earn 20% returns for the next 5 years, and then who knows what happens after that, or you can earn 10% returns for the next 50 years. I'm going to take option 2 every single time, all day long, even if I'm earning half the returns of my neighbors.
Postscript. The postscript of the book is actually very interesting too. Here Morgan gives a brief history lesson of why the US consumer thinks the way we do, how everything changes, but we change with it, and thus our expectations stay the same. I hope you have enjoyed my attempt to summarize Morgan Housel's great book, and if you did, please like the video, and I hope to see you in the next one. Remember to invest in you. The more you learn, the more you earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the night inning. There ain't no point in resisting. Living